Good evening, everybody. Have you been trying to figure out what kind of down payment you need for that first home? Are you trying to figure out what your closing costs are going to be? Are you trying to figure out any type of lending question that comes into your brain? Well, today we do have a special guest with us today. His name is Josh Glenn. If you have worked with me at all, you've heard his name before. So this is Josh. He is hanging out in his car with us today. So it's a little bit dark, but I'm sure you can see him. So Josh, tell us a little bit about yourself. Tell us a little bit about how long you've been in the mortgage lending industry and a little bit of what states you cover. Can you hear me?
Right. Yeah.
Okay.
So, been in the business. Yes. Can you hear me okay?
Yes, just as loud as you can speak.
Been in the business about 11 years now. Yep. So, been in the business for about 11 years now. And currently the vice president, sales manager for Gateway Mortgage. And I am licensed in all states. We do loans all across the nation. Love what I do and love to talk about mortgage.
Awesome. So if someone is thinking about making that first purchase, we'll start with first-time homebuyer questions because they are very common, and I do get quite a few of them, as I know that you do as well. But if someone's thinking about making that first purchase, and this is the common question: how much money should I save for that first purchase?
Between 3 and 5%, roughly 3 to 5% is the minimum down payment, unless you're a veteran and can go the route of VA. In that case, that's 100% financing. The reason I say between 3 and 5% is
Oh, you're cutting in and out. Now I can't hear you.
Can you hear me now?
Yeah.
Okay. Sorry, guys. I was getting the call. So the 3% down is an exception basis right now. 5% is more common. But there's more that goes to your cash flows than just a down payment. So as 3 to 5% is the common minimal down payment that's required from a customer when buying a primary house, you've also got your closing fees, your title fees, and your lender fees. You also have your escrow account. You've got to build your taxes and your insurance, which consist of 3 months of property taxes and 15 months of homeowner's insurance. So some of those are somewhat unknown, and we can do a guessing game and calculate conservative numbers so we know on the front end of about how much we will need at closing, right? But as far as down payment, 3 to 5% is a good figure to have when thinking about how much you need at the closing table.
Okay. So if let's say that my spouse and we make together $150,000 and we have good credit. So let's say that our credit is close to that 758, maybe closer to 8. Like we have really good credit, threshold for credit. What can we expect for how much house could we potentially afford with just do you need any more? Oh, well, let's say that we don't have very many debts. Let's say we don't have any student loans. We own both of our cars right out. In that type of situation to where we're making $150K together and we don't have a whole lot of debt, maybe a credit card, but we've probably already paid it off. What kind of approval would that person kind of get, just in general terms?
Sure. Yeah. So, and to your point, I'm glad you caught yourself on the debt, because it doesn't matter how much somebody makes if they have a lot of debt, right? So, I mean, I guess the easier way to answer that question is there's 3 main qualifiers that we look for to see if somebody's approved: credit, income, and assets. debt to income ratio goes into kind of all of those except the credit, I guess. So the max debt to income ratio is 45% on a conventional loan, which is the most common loan, right?
Okay.
So when I'm calculating income, if somebody has a base salary of, let's make numbers easy and say 120,000, right?
Okay.
That's $10,000 a month. And then I'd multiply it by 0.45%, which would tell me that $4,500 is the max amount of debt, total debt, before they reach that debt to income ratio ceiling, right? So in that scenario, I'd say, okay, so $4,500 is the max debt. How much is this house they're looking to buy, right, with taxes and insurance, minus any other debts that they have? And if they're under that number, that tells me that they're in a good position from a DTI, debt to income ratio requirement, right? So when I'm pre-qualifying somebody, I'm asking all of those questions. What is the income? How are you paid? What debts, what credit obligated debts do you have? Typically credit cards, as long as there's not substantial amount of debt on credit cards, those payments are usually fairly low. What I'm typically seeing that puts people over the debt to income ratio is usually auto loans, or when people have co-signed for a family member, on auto loans, or student loans is another one that I've seen kind of push people across that threshold. But it's hard to say, and I'll transition into how somebody is paid also tells us how much usable income we can use for that mortgage transaction. If somebody's base salary, W-2 income, that's fairly easy. As the scenario I gave you with the 120,000, $10,000 a month, $4,500 of usable debt. If somebody is self-employed, it gets a little bit tricky. Or variable income, commission, 1099. Then you're looking at a 2-year average minus any write-offs, deductions, or losses to determine an income that's usable in mortgage for mortgage financing. So there's a lot that goes into mortgage, and that's why I think it's important to talk to a professional that knows these guidelines, that knows what questions to ask to make sure that you're approved, right? And it's an accurate approval. It's a very long-winded answer to your question, but hopefully that helps.
No, it does. So let's explore. I want to remind people too that if you're watching and you have a question, feel free to put it in the chat. I'll be monitoring the chat questions in the chat as we go. So that way, if you have any questions, just put them in the chat for Josh, and he's going to answer them as best he can. I want to kind of explore, though, now a little bit of the job situation. So let's say that we'll just take myself as an example, because I'm not your standard W-2, I'm commission based. You talked on if I wanted to get a loan for a property and you looked at my credit was good, and you're just basing the loan off of my income. What would you look at specifically, and what would I need to provide for you in order to figure out, how much I could potentially qualify for and kind of move forward from there?
The first thing I'm looking at is, what is your net income, right? What is your net income after your write-offs? I'm looking to see if there's any major losses. I'm looking to see if there's any depreciation that can be added back in. Ultimately, someone in my position couldn't tell you an exact dollar amount of what the usable income is, because there's a system for that. Depending on the mortgage company, they have different pathways of getting that done. But some it's inputting into a system that runs through those tax returns and calculates that income and pops out a number. Others want an underwriter to go through there and follow a certain income source to calculate that income. Somebody as myself can look through a tax return and get pretty close, pretty close. There's a lot that goes into that. And I think that going into that would take a lot of time, and there's a lot of different how people file the returns and what kind of businesses they own. There's different answers to that question. So to keep it more general, I would say the net income after write-offs, deductions, or losses, 2-year average, and that is typically the number that is used for that person. So if the last 2 years of tax returns show 300,000, and they're writing off 150,000, then odds are the usable income for mortgage financing is going to be closer to that 150,000.
150.
You see what I
Yeah.
mean? Whereas if somebody was base salary making 300,000, it doesn't matter what they're writing off. The full amount of that $300,000 is being used.
Mm-hmm. That stinks, you know.
So it does, and you've got to understand now that it's not so much the lenders anymore, and any loan amount under 548,000, we are all underwriting to Fannie Mae and Freddie Mac's rules, unless you're doing FHA or a VA, and that's government loans that are similar to conventional conforming loans, right? But they set the rules and regulations that we all have to abide by. And once you go over 548,000 loan amounts, that's what's called jumbo financing or non-conforming. That is when it is completely up to a bank to decide how to underwrite that file, which 9 times out of 10, those banks will follow. They'll mirror the investor guidelines. But in all fairness, the investors are out of the equation. It's completely up to that lender on how they what they want to do and how they want to underwrite that file. So so I agree with you. It stinks, and I guess the investors' thought process is there that if you're self-employed or you own your business and you make 300,000, but you're writing off and you're only paying taxes on 150, they're saying, well, then you needed to spend that $150,000 to come up with that net amount. Therefore, that's the amount we're going to use as a conservative income for you. That's my guess of why that is. Where if someone's base salary, it's an employer paying you a base salary, a fixed amount that is likely to continue.
It's fixed. Yeah.
So just to give some extra information around that and try to explain why that is.
Yeah, I think that for a lot of people like myself, it almost seems like if I'm planning to purchase a home and I have my own business, that the next 2 years, if let's say that I'm purchasing 2 years out, so that means that I need to be saving up, or not saving up, but I need to be, if I want to get approved for the most amount, I need to make sure that my deductions are as minimal as I can make them. So that way it shows that I'm essentially making more. So that way I can get approved for more. Am I using the right logic in that type of situation?
Yes. And that's hard. That's hard to tell somebody that's self-employed. But yeah, I'll say this, a lot of CPAs, my advice is, if somebody is self-employed or variable income and they know that they're looking to buy a house in the next couple of years, let your CPA know that. Let your CPA know, because most of them know what they could write off that could be added back in. Like I can tell you depreciation. If depreciation is an option to be written off, that can be added back in. If it's a one-time loss and is not likely to continue, that can be considered to be added back into your income. There's things like that. So a lot of CPAs are knowledgeable in what income can be used for mortgage financing. So I would have that conversation with the CPA. I would even talk to your loan officer as early as possible, and sometimes it's not the case. Sometimes it's, that you've got to move for whatever reason. You don't have that 2 years to wait, and it is what it is. Right. But, anywho's, but yes, you do have that right. I mean, I would do your best to limit certain write-offs, so that you can show more money that can be used on mortgage financing. Yep.
Right. Okay. So that would be one strategy. I guess the other strategy would just be to save up money, essentially, to where you're not having to depend so heavily on the financing aspect too. So that way it'll kind of, offset it a little bit that way. So that way,
Sure.
You have extra cash, to bring to the table that you're setting aside and you're saving up, in that type of situation too. It'd be something similar, a similar strategy for self-employed.
Well, correct. Yeah. And you've got to think that obviously the lower the loan amount, the lower that you have to finance, the lower the payments, therefore the lesser,
less risk.
Less risk, therefore lower on the qualifications, right? I mean, so if you put down 5% as opposed to 20%, you're going to have mortgage insurance, which essentially is a fee for not putting 20% down. That's
Right.
an extra debt that's going into your ratios, right? So the higher the down payment, the less loan amount, less debt that we have to calculate to get you approved. So sure, the more money you can save and put down, the better the rate, the less risk, and typically the easier the financing.
Mm-hmm.
Yeah.
Another common question that was really good. I think those that are self-employed will really benefit from this information. So that way they can kind of strategize how they want to move forward, whether it be now and they're kind of looking back, or, you know, a year to 2 years down the road. It'll be super important for them to know about this. What are some other things that a person who is self-employed could do to help their overall lending mortgage situation, aside from the strategies that we talked about, whereas just try to save up as much money as you can so that your loan amount is smaller, or to write off as few expenses as you can to show that you're making more income. Are there any other tips or strategies that you'd like to share with those that are self-employed?
So self-employed covers a wide spectrum of different incomes and
Industries too,
right. So I mean, keep in mind that if you're W-2 income, if you are a true business owner, 100% sole property, and you own a business and you're able to pay yourself a salary, remember that salary, there's no variance to that. That's being used. So there's a lot of people that own sole prop businesses that pay themselves a base of 60,000, right, and then take the overs from the business. That 60,000, there's no variance from that, right? So when that's applicable and somebody can do that, there's no 2-year requirement, right? If they pay themselves a base income, that money can be used immediately. So that's one way.
So if you're trying to transition from the commission-based to a sole proprietorship or LLC, or one of those, to where you are paying yourself a salary, how much time do you need between not S corp and S corp, essentially?
So basically, what you're asking, if somebody were to pay themselves a base salary, how much time would they need to show that, to have that used towards income? Yeah.
Correct.
So that's where it gets a little gray. So let me answer that with 2 different scenarios here. If somebody has a base salary, let's say an offer letter, we could technically close a loan on somebody that has an offer letter that's paid a base salary. We could close that loan a week or two before they even start that job. We would call the employer and do what's called a verification of employment. We'd verify within 10 days of closing that they're still looking to start, within the next, I think it's 2 weeks from the closing date. We can close on that house. If somebody is self-employed and they've the last 2 years of returns don't show any W-2 income, and then all of a sudden, a week or two before we do application, they've got base salary income, an underwriter may question that. But the guidelines say that if you are W-2 income, that income is likely to continue, and there's no variance from that amount. So I guess I would preface by saying that if you are self-employed and if you pay yourself a salary, an underwriter may want to see some small history.
Yeah.
I don't think that it's kind of to an underwriter discretion to make them feel comfortable. It's a very gray area there, right? So I mean, if we're in April now, right? If somebody started off the new year and paid themselves, said, in 2021, I'm gonna pay myself basically 60,000. There's been this 3 or 4 month history of them paying themselves that, right? Should be fine, right? I don't think any red flags go off there, but that's a little tougher of a question to answer, and can be case by case.
Okay. I wonder, and I guess because, for me, those that are growing their business, just even from my personal perspective, I'm eventually going to take that and pay myself a salary because of the growth of my business. And I know other small business owners probably do something similar, whether maybe they own a lawn service or if they own a contractor, they're a contractor and they have, their own business through like an LLC that way. Or if they own a roofing business and they have their own S Corp through there. So I can see, because if I were to transition into paying myself, I just said, let's just say in May, starting May 1, I'm going to start paying, myself as a base salary of X. I know that I probably need a couple months to show that I'm continuing to pay myself that. And then plus they can look back at previous tax returns and take all of that into consideration as far as what I was doing prior to that as well. But that's good to know that I'm not just stuck in this, I guess, small business of bubble of this, to where that's not the only possibility, I guess, is kind of what I would add to that. But it's good to know that there's other ways to kind of not get around it, but to, giving yourself a salary, how that could benefit your loan situation is really important.
Right. Yeah. And again, I would welcome anyone in that position to talk to their mortgage professional early. I mean, it's far too often I see the cases where somebody is self-employed and they're looking to buy a house immediately, and in mortgage, there's a lot of complexity in mortgage, right? And a lot of people will say, God, this is a lot of documentation. This is a lot of work. Like you need everything but a blood sample and hair follicle test, right? It's crazy. But if you think back on 2008, whenever it was completely opposite. It was stated income. You could tell me how much do you make? $400,000 a year. Great, you're approved, right? And there's a lot of people in houses that were not qualified, and there's a high foreclosure rate. There's a lot of bad people investing into real estate, and on one hand, it should never go back to that. And now it's the other side of the spectrum where it's heavily documented. But you've also got to understand that we've got the lowest foreclosure rate in history. And if you're getting a loan for $300,000, $400,000, $500,000, they're going to ask questions. The investors have the right to ask questions and see documentation. But I think that it's always best. I always welcome people as soon as they start considering. Once they start considering buying a house, talk to a professional. Lay it all out there. Get the whole story out there, and that way you don't have any surprises. I mean, one other thing I'm going to transition into is the pre-approval letters, right? Most people call in and say, hey, I'm looking to put an offer on a house. I want to do a pre-approval letter. Well, those pre-approval letters can be done in the same day. Pretty quick and easy. There's also the commitment letter, and I know you've heard me talk about this. I'm a big fan of this. Not all lenders will do this, but a lot of lenders will allow you to submit documents and go through underwriting and get what's called a commitment letter or a hard approval letter, loan approval letter. And the difference, obviously, is a pre-approval, if you read through the verbiage, is not a guarantee. It's basically saying that the information you put down on this application is issuing an approval through the investors, Fannie Mae and Freddie Mac, right? And then the commitment letter is sending the documents in, having an underwriter actually review your loan and sign off on the documentation that you have, review your credit, your income and assets, and give you a hard approval. So when you go to submit that offer, like in this market right now, those are huge right now. If I'm selling my house and I have 5 people showing me a pre-approval and I have one guy showing me a commitment letter, odds are I'm choosing that guy. He's the for sure deal, right? So I guess my point there is that it absolutely makes sense for anyone, not just self-employed, but to start the process early. And if you can get that commitment letter, not only do you have a better chance of winning that contract, but in a market outside of what we're in right now, a lot of times it allows you to have better negotiations, right? I mean, you've got that golden ticket that should help you win that contract and win that house that you love. So I know I kind of transitioned off there a little bit, but I thought that was important to talk about.
No, you're good. It looks like a police car is like about to pull you over because you got red light now over your face.
Yes, I've got the brake lights of a big truck in front of me that is flashing me.
You're good. So to kind of, I guess, transition into the next part of it, I wanted to ask you a little bit about, well, I guess let's talk a little bit about the multiple offers and how, in certain situations, like you said, I think knowing your finances too is really key, because if you're offering 20,000, 30,000, 40,000, 50,000, 100,000 over asking, you really want to know if what you're offering them is, can you bring the extra to the table? And a lot of time the seller will want proof of that, as uncomfortable as it might be for you to have to bring that overage to closing. Knowing your finances, knowing how much you're going to need to bring to the closing table, worst case scenario, best case scenario, is super important. Otherwise, it's just kind of like you're playing Russian roulette with your option money and your earnest money at that point.
Yeah, you bet. Yeah, it is a seller's market. It's a very competitive market, and there's a lot of people willing to pay over a home's value, right? And as this has been more and more common lately, it's caused me to adjust what I talk about with customers on the front end, and to prepare for that. And it can get discouraging, right? Mm-hmm. But it makes it that much sweeter whenever you do get the contract. But yes, yeah, I mean, right now it is a situation where you're in a bidding war, and a lot of times who has the best offer, strongest offer, is winning that bid. So absolutely, money talks. The more money you can save. Keep in mind that if you need to get gift funds, if you have family members that can gift you money, that is an acceptable pathway. As long as it's a family member, mom, father, sister, brother, aunt, uncle. If anybody's willing to gift you money, that is money that can be used for mortgage financing. So there's a lot of things we can do there. But yes, yeah, I try to prep all my customers now for that.
Yeah. What are some other ways that people can use to, I guess you have the gift, which is one way that you can help with the overage, especially if you're a first time buyer, because you're really getting beat up. I feel like a lot. If you're a first time buyer and you're in this market and you're trying to compete, it's super hard because number one, we have people that are moving here into Texas and they move from a state that has a higher cost of living, like California, New York, New Jersey, even parts of probably Florida. If they're moving here from, I feel like almost anywhere, maybe except with the exception being Oklahoma, because Oklahoma is kind of dirt cheap, not in a bad sense, but you can find anyway. I digress there, but with everyone moving here, that's moving here from a higher cost of living state to a lower cost of living state, they have a little bit more in their pocket to play with versus someone who's lived here all their life and has been scrounging around for whatever they can get right here in Texas. So those people are pushing out first-time buyers in this direct market. But the other thing that is pushing first-time buyers out too is the fact that if you just sold your house here or somewhere else, whatever overage you got for your property, you can actually use that overage in the bidding war to kind of help you win the other property. And you may not even have to use all of the overage, especially if you're coming from a state like California and you got an extra 50 to 100K over asking. I mean, you've got quite a big, amount to just fling around there from the income from your asset that you just sold. So with first-time buyers, it's very difficult because even if they've saved up so much, it still might not be enough to compete against those two types of groups that I just talked about. So gift fund is one way. What is another way if they wanted? See, this is the other thing too. And I'll talk to you about that a little bit later and other strategies. But what are some other ways that first-time home buyers can where are some other funds that they could, I guess, get income from to help them, is what I'm trying to say.
Income or assets?
Either one. What's another way that they could shell out some more money for overage aside from gift funds?
So I mean, there's down payment assistance programs that is money from the government that would help you with the down payment. There are typically a lot of qualifying factors there. There's a lot of DPAs, down payment assistance, that have gone away since COVID that I think will be coming back in the near future. But and there's a lot of different programs. To go over all of them would be difficult, but I'll just say that a lot of them are either there's a certain income limit. You know what I mean? It might be 56,000 total combined income for a family to qualify for this down payment assistance program, or some of them are that if you're buying in a rural area, that those can be used. There's a lot of, in this transition back to talking to your loan professional, but those are some of the things that we look at in an effort to try to help as well. It really, I mean, I can't stress enough. I mean, it's when people are trying to buy a house immediately and are trying to do everything right then and there, you really need to provide enough time to fully analyze the situation and see what the best course of action is, right? I mean, there's a lot of options, right? But knowing the full story and having the time to do so, I think, is important. But down payment assistance is another way that some people could utilize, especially first-time home buyers.
Right. Yeah, I know that the other thing too, what about people that have a 401k that they could borrow from temporarily, or what was the other thing? Stocks.
I mean, you could liquidate stocks
if you want to. I thought you said socks.
Yeah, or socks. You could sell socks in the corner, lemonade stands on the corner of the streets at parks and things. Sure, yeah. Anyway, but no, stocks. You can liquidate stocks. 401k. It's not something I see terribly often, but may be a pathway depending on the customer and the ability on their 401k. There's a lot of different ways. There is. I'll tell you what more commonly what I run into and what cannot be used for mortgage financing is cash. Cash can't be used, and I see that a lot. Much more than I thought that I would. But I see a lot of scenarios where people say, "Well, I've only got $2,000 in the bank, but I have $10,000 in cash under my mattress," and that's hard. The investors do not like that. Why? Because that goes back prior to 2008. A lot of bad apples that were investing in the real estate, and so assets have to be sourced. We have to be able to see that in some kind of an account.
Right.
If you go and you say, "Well, I'll just deposit to the bank, and then I'll go talk to the lender," we will see the last 2 months of your bank statements. We will see that cash deposit. We will ask you what it is. You will say it's a cash deposit, and that money will not be able to be used. So again, the cash is unsourceable. They don't know where it came from.
How long does it have to be seasoned in the account for it to be counted?
We have to collect the last 2 months of bank statements. The two most recent bank statements is what we have to collect. So typically 2 and 2 is what we say in the industry: 2 pay stubs, 2 W-2s, 2 months of bank statements. There are some exceptions, right? I mean, let's say that somebody just sold a boat and got $18,000 in cash. Well, in that case, we would say, yes, I sold a boat. We'd get an email from the customer that say, I sold a boat. He paid $18,000, and that's why there's $18,000 cash deposit going into my bank account. They would typically also ask for a bill of sale to document that. So I guess the point of this is that if you're looking to buy a house and you have cash, put it in the bank. You're FDIC insured up to $250,000, at least with most banks. So a friend of mine that similar situation. He's got about $15,000 in cash in his mattress. And John, what are you doing? Why? And he's like, well, I don't trust the banks. Well, okay, your $15,000 is protected. I promise. Yeah. If you're looking to buy a house, put the cash in the bank so it can be used. Otherwise,
Yeah.
you're just gonna find yourself in a tricky situation.
Mm. And Randy mentioned, he's one of the regulars on my show. He says that he cashed a retirement CD, sold a vehicle for extra cash too.
Sure. Perfect.
So as long as it's documented and that you can source it and you can trace it, then we're good to go.
Yeah, absolutely. You know, I mean, like it's so again, if you have that in a bank account, I'm gonna say 2 months. I'm gonna say 3 months because I don't know when the ending statement balance is, right? But again, as long as we don't see a large deposit in those 2 months of bank statements, there's nothing to discuss. If we did, right? If we saw if that deposit come over into your bank account, we would ask you what it is. You'd tell us what you told us, and then we would source it. You know, it's kind of like anything else. Most common I see. Here's another thing I see a lot. I see a lot of people saying, okay, well, I've got 5 different bank accounts. I need all this money, and I'm going to move all this money into this one account. That's great if you do that 3 months prior. But if you do that in the 2 months that we need to see the bank statements, that's a little bit of some fun that, or lack of fun, because we're going to have to track all that down, right?
Yeah.
And so, and again, and I would be like, hi, yeah, I moved $15,000 from my Chase account to my Wells Fargo account, and then we'd have to show that statement, see that money coming out of Chase and into the Wells Fargo, right? And again, just it's a document. Make sure it's your money. Nothing funny's going on. And
it's just really, to me, it sounds like they're just trying to protect against any type of money laundering because they want to enforce it. You know, they want to make sure that you you didn't just take all the marijuana that you grew in your backyard and decide that you want.
You'd be surprised what I've seen. I mean, it does happen. People think that's crazy. I have seen it. Yes, it does happen. It happens.
You want to make sure there's no black market stuff going on.
It happens much less nowadays because of these tight guidelines, but it still happens. So put the money in the account well in advance. Most people know that they want to buy a house. It's usually not waking up in the morning and saying, I'm going to buy a house today, right? So when you're considering it, put it in. You can always take it back out later, but try to get it in there as soon as possible. You bet.
That's good. What about if someone wanted to, let's say they have a parent who wants to co-sign for the loan, and the parent, what about if, because that might also bump them up as far as how much they could afford. What would you say to someone who's considering a co-sign situation?
Yep, that is common. So that's usually done whenever there is debt to income ratio issues, and somebody just doesn't have enough income to qualify, and they need a parent, family member, or whoever to co-sign on that loan. The takeaway there is that we can consider their income, but we also consider their debt and their credit score, right? So if somebody is making $1 million a year, but their credit score is 450, there's nothing that can be done, right? They got to pass the credit, income, and asset requirements. So, but yes, that's very common. They would go on that loan. They would have ownership on that loan. They would be a signer on it, and that's fairly common. There's sometimes that we do the pre-approvals and we say, hey, look, we see you that you really want this $400,000 house. We're a little shy of that. Do you have a family? Do you have anyone that's interested to go on this loan and co-sign it for you? And that's when we restructure the file and run another, add another co-borrower to that loan to qualify. Yeah,
okay.
Very common.
And then, Michelle was saying, she's also another regular on my show. She said, thanks for the great information. She said a commitment letter sounds interesting. So, and I think it's called things differently. I think a pre-qual is to me more of just the verbally getting approved, and a pre-approval is pretty much similar to what the commitment letter would be, but everyone calls it something different. I think the listing agent, if they're any good, they would verify that that has whatever assets and income have been actually sent into the lender, and the lender has actually checked off that box. And it does depend per lender, because every lender is going to assess that differently and go at it at a different angle. So choosing your lender wisely does help in a lot. And
so I'll further on that. So pre-qual, which is very rare nowadays. A lot of agents don't really like to accept those. Pre-qualification was whenever you'd call me and you'd say, I make $100,000, I have $50,000 in the bank, and my credit score is 740, and I would type up a letter, pre-qual letter, says customer has stated to me this information, right? Pre-qual letter, basically obsolete nowadays. Pre-approval is by far the most common, where we send you an application, you complete the application, you send it in. It does pull your credit, but not necessarily always do you have to provide documents, right? So the pre-approval is basically saying the stated income on the application, as opposed to just verbally telling me and me typing up a letter on a letterhead. You're actually doing it in an application, right? Which is the next best thing. It is pulling credit, so you're passing that, but it is somewhat, the income and the asset documents don't have to necessarily be sent in for that pre-approval. The commitment letter, and again, the verbiage can be different from certain lenders, but the takeaway here is that if you can actually send your application, which a lot of lenders will do this, some will not, but if you can do that application, right, get that pre-approval letter, which is great, right? Now you can go look for houses, but simultaneously, as you have that pre-approval letter, I am gathering your documents, I'm sending that file through underwriting, and I'm getting that commitment letter or hard approval letter, right? The verbiage is different on that. So as the pre-approval letter will still say, this is not a guarantee. The verbiage will change, but most of them say that this is not a guarantee. Send documents to your lender for a full underwrite or something to that effect, right? And then the commitment letter, as it looks very similar to the pre-approval letter, will say, this is a commitment. This is the commitment to do this loan. So if you quitting your job, going on a major shopping spree, or open up a ton of new debt, we'll do this. We'll do this loan. I mean, you are initially approved. And in my opinion, the initial approval is arguably more important than the final approval. The initial approval is the guarantee. The final approval is dotting the I and crossing the T's. So, Michelle, great question. Thank you for chiming in, by the way. Excuse me. But the commitment letter, I mean, you can see why when you're putting an offer down, if that listing agent sees that this is a underwriter approved, it essentially eliminates any concern. I mean, you're right up there next to a cash buyer. Almost. Almost. It's as close as you get to a cash buyer without being a cash buyer. Right. So it's so again, not every lender will allow that, but the ones that will, and when you have the time to go through there, that's huge.
Yeah. No, it is a pretty big game changer, which is why it's so important to hire a local lender, not only for that reason, but I also feel like the appraisal has become a bigger issue now and a bigger deal now, to where if you decide to hire a lender that's not local and they send out their appraisers, you may not get an appraiser from the area, you may get an appraiser from Houston. And then if you're depending on that appraisal to be up in value and to have the right information for that appraiser to know the area, do you think if they're from Houston, they're going to really know the area and know the market here? Probably not. They could probably get an idea, but a local appraiser is going to have a lot more knowledge about the market because they've been doing appraisals in the market. They have that knowledge. They know month over month. A home that sold in January compared to a home that sold in March, two totally different markets. I mean, that's how rapidly it's changed. So does Gateway, since Gateway is the company that you work with, does Gateway provide a pool of local lenders?
Local appraisers?
I mean, appraisers, sorry. Yes.
So kind of. That's a that's a touchy subject because someone in our position cannot
Mhm.
have any communication with that appraiser for fear of conflict of interest, right? I mean, it's you want. So I'll say this: the more established mortgage companies, as opposed to these smaller mom and pop broker shops, typically they have more appraisers. They can get it done quicker and are more knowledgeable to the area.
Okay.
So there, to your point, yes. If you use a small brokerage firm and you're trying to buy somewhere that is not near where they're located, you're probably going to get an appraiser that is not in tune with that market, right?
That immediate
Where if it's a bigger,
yeah.
like Gateway's a national mortgage lender, right? And they have contracts with appraisers all across the nation. So when you order an appraisal, it's going to be somebody that's local to that market, wherever it is across the nation, right? But really, in all fairness, there that's one of the things that we can't touch on. You know, I mean, we order the appraisal. We will send the contract to the appraiser, right? So if you're buying a house, that appraiser knows what the target goal is. Now it's their job to look at the comps, the houses that have sold near that subject property, and determine an unbiased, true value for that property. You know,
Yeah. An opinion of value. Yes, for
an
sure.
opinion of value. Sure. But I think that them seeing that contract and knowing what the purchase price is and the target goal, you know,
Hmm.
they know what number they're trying to hit. It's just a
Hmm.
matter of if they can get to it or not. And
Right, because they
you
put their
know,
license on the line. I mean, they really do. As tough as their job is, especially right now in the craziness of crazy with the market. I mean, that taking a step back. I mean, you really have to, every time they do an appraisal, they put their license on the line essentially.
right.
So they're not going to fudge the numbers. They're going to do what they think, right? It's always an opinion. One appraiser is going to be totally different from another. So we have to take all of that into consideration too, when it comes to the appraisal. And you can, I mean, offer alternative comps and see what they say and see if they see where you're coming from. And, you can try that too, but often 9 times out of 10, they're going to stick with their original amount.
Yeah, I actually just won an appraisal dispute. You know, it was kind of a one-off situation. It was in Georgia, and it was a builder, and the home that this guy was building added a $45,000 basement. I think I may have told you about this one,
Yeah,
but
you did.
he added a $45,000 basement. But the appraiser that was appraising the houses used the comps. They're supposed to go with the houses that have sold. They're most like that subject property that are
Mhm.
nearest to that home, typically within a
Right.
mile or two, right?
Yeah.
Unless you get to the rural areas. What that appraiser did not know is that the homes that were about $45,000 sold for about $45,000 less did not have a basement. So from the
Mhm.
appraiser standpoint, he's thinking, man, all these houses that have sold appear to be, much less. I don't think this guy is. I think this guy's getting ripped off. So he wasn't going to just appraise that home higher. And in all fairness, I would have to. I had to kind of lean on the builder a little bit. You know what I mean? That was their job to let them know. They let that appraiser in there, and that was their job to let them know. Hey, by the way, these other houses just sold. They do not have a basement. Here's what.
Mhm.
So I didn't even know that. I'm the finance guy, right? And then once we got the appraisal in and it came in $42,000 less, I started asking questions. Get the customer on
Yeah.
the line, the builder, and quickly, or maybe not so quickly, but found out that the basement was the causing factor. And so
Yeah.
I got the builder to send an email and documentation on how much that basement cost, disputed that appraisal, typed up my notes, sent it in, and we got that. We didn't only get the appraisal back supportive we got it like $5,000 over the purchase price. Guys was
Wow.
happy, closed on time, everything was good.
Yeah.
Yeah. So, yeah, anyways, I don't know where I was going with that. I just,
Well, I
I
mean,
think it's
sometimes it's an odd situation. You'll have a property that has a pool, and there's no other properties that sold within a mile that have a pool. So you have to make an adjustment for that pool. I mean, the same could be said for, one property in particular that I was looking at today. It wasn't in a subdivision. Everything else that had sold around it in a subdivision. How's the appraiser going to look at that, right? Are they going to
right.
give more value to the homes in the subdivision? Probably. Um, so I'm not sure where this property could appraise at. So it's a very risky situation to say, look, I have no idea where this property is going to appraise at. It's a very unique property. It's not in a subdivision. We could use comps, within a mile, but still that would be very, very difficult. We may have to go further out, maybe further back in time. So, I mean, there's a lot of indicators and a lot of things that you have to consider, as far as value. Views have been another factor too. So does the property back to another property? Does the property back to a busy street? I've seen a lot of, my friend who's an appraiser, I had her on the show recently. She was saying that there's a home that she was looking at. She said the properties that back to like the power lines and to the busy streets, those aren't getting as much of a deduction right now because of the market. People are buying up those properties as if there's none left, which there aren't, right? This is
That's my
because
house, by the way.
shortage. Yeah. So that deduction for the big power line behind the house or the big water tower, that's sitting right behind you is not going to be as big a factor with the appraisal in this market as of today. But down the road, you're going to see that deduction kind of creep in and maybe become more of a bigger deal down the road. So it's still going to play in a factor. And then the ones that have the beautiful view of the creek bed, or they back to Corps Engineer property, or they back to the golf course, I'm not seeing as much money given to those properties either, because of the whole, yes, it's a desirable property back to the golf course, but someone could easily, another property within that subdivision that doesn't back to the golf course could still be just as desirable. So I think because of the shortage, they're not, necessarily giving as much money towards those properties that back to this, unless it's like, lakefront or ocean, that to me would be a huge deal.
Yeah.
But I mean, if it's like a creek bed and, or, it's not going to have as big of an impact.
It's there's a lot of factors that go into an appraisal. I would like to be on that show with that appraiser that it's a friend of yours, and if you have him or her back on, I'd like to join. There's a lot of
Yes.
questions I'd like to ask personally. That would be a fun show to watch. We need
Okay.
to set that up.
I'll set it up.
but there's a lot of thoughts that I have on the appraisal. But again, like really from our standpoint, of being a loan officer, a mortgage consultant, there's really no interaction between us and the appraiser. I mean, you
Right.
yourself in your position have much more interaction with the appraisers than we do. We just get it back. I've developed enough knowledge to be dangerous in that area over the years, and doing appraisal disputes and just inquiring and asking questions. But you're right. I've kind of seen that as well. That the views in this market really aren't adding much. It's everyone's paying over the sales price. So it's just a different time, crazy market that we're in.
Right, for sure. So Michelle, yes, she thinks that Oklahoma is really affordable. Yes, relative to Texas, I would say yes.
Except Broken Bow.
Right.
Broken Bow's got a little out of hand.
Lakefront, probably, on the high list.
Yeah.
But if you're just in Oklahoma and you're just outside the city and you're, you can see the flatness of, all the way down over here, then it's probably safe to say that you could find something for dirt cheap over there. All right. So this is a good question. So Michelle is talking about TRS. TRS stands for teacher retirement. TRS is what teachers will pay into. Um, and you only get that money from the TRS if A, you teach a certain amount of years, or B, what was the other caveat to that? But you have to pay into that for a certain amount of years before you can even get the money out of it. She's thinking if she were to use some of her money towards her that she has in her TRS account towards the sale of her property. Do you know anything about that specific, I guess, retirement plan and how she could pull any of that out or borrow against it?
I don't. I'd be welcome to call in with her to find out more on it. I've had
Okay.
customers use it, but on my end, we're just seeing the statements and the usable income from it. I've seen people use the income from TRS, but
Mm-hmm.
other than the specifics around it, I've been withdrawing that money.
Mm-hmm.
I don't know enough to say that. I've never done that personally. I do have, actually, most of the people in my family are teachers that I could probably ask. They might have more information on, but I wasn't involved in any of those scenarios where I've had customers use the TRS. On my end, all I just saw was the money coming over from it, right, and being used. So as far as what restrictions you have or don't have, I couldn't talk about that. I'm so sorry, Michelle. I don't have a good answer for you on that one. But I'm happy to look into it and get back to you, Rebecca, if you want to get back to Michelle for me, and I'll get you an answer for that on tomorrow.
Yeah, that's not a problem.
Okay.
Kind of leading into that retirement question, if though you have someone who's retiring and their income that they're receiving is from TRS, or if it's from, I know that I know that you've helped my mom with a couple of her things, but those that are maybe receiving a fixed income from, let's say, the stock market, or maybe they're receiving Social Security on top of that. What type of things, what type of red flags, I guess, would, since that's a different type of income, you don't have a job, you're not working, those people that are in that situation where they have a steady fixed income coming in, how does a lender view that?
There's really not much complexity to it. So when you have fixed income, we're looking for the likelihood of continuance. And if you have a fixed income, odds are it's likely to continue. If you have Social Security income, we show an award letter, right? And that's likely to continue. It's actually likely to increase, but it's likely to continue. Therefore, it's used. There's not any variance to it. There's certain other kinds of incomes that get more tricky. I think where you're going with this, as long as it's a fixed income, if it's variable,
Okay.
if it goes up and down, we need a
Mhm.
history of it, right? Because if you have $5,000 of income this month, 7,000 next month, 2,000 next month, what amount do you use? What amount is likely to continue, right? And that's what we have to do as a lender to satisfy the investors when coming up with an accurate debt to income ratio. What is the likelihood of continuation? What amount? So if it's a fixed amount, that's easy.
Okay.
Right? It's only whenever the income is variable.
Okay.
I was going to get into a scenario where, I've seen this not a lot, but a couple times where someone tries to use border income, right? Like if they have a student staying with them that's paying rent out of their house, right, and things like that, that gets a little tricky, right? There's certain kind of, if you have any kind of income stream that is out of the norm, it's best to talk to your lender early. Go through underwriting, get that commitment letter, let them ask the questions, document to make sure it can be used, and if it can be used, what amount of that income can be used. All of it, some of it, part of it. But if you have a fixed income, there's nothing that's coming to my mind right now that would have any variance of that. As long as you could document it, it wasn't cash. it should be able to be used without any kind of variance from that number.
Okay. With the variance though, would you more likely take the route of average or the amount of median when it comes to those variable numbers over the course of a couple of years? Let's just say that.
Give me a scenario. What kind of variable income?
Let's just say from the stock market, they're, 1 month it's 5,000, next month it's 7, the next month it's 3, and then they've got 5,000 again, and then they, it's variable income. It's steady, but it's variable. Would you take a median in that situation, or would you take an average? Average to me is going to be more safe from the.
We wouldn't use, so the money from the stock market would not be used as income. It would be used as assets, not income.
Okay. Oh.
So we can't say can't use stocks as income.
Okay.
It can be used as income. It can be used as assets, and I think the better question might be, I have $200,000 in stocks right now, right? And next month it might be 180, right? The month after that it might be 210. There's some variance there. It'll move. The stock market moves up and down depending on what stocks you have.
Mm-hmm.
So if somebody was using stock, and that's somewhat common, if they are, and we were close to the max amount that they had in their stock account, like let's make numbers easy. They've got about $100,000 in stock, and they need $95,000 at closing, and that's the only account that they have. I would question whether we really want to be buying this house, and God forbid, either liquidate right now, or we might be in a tough situation, right? So if we're using stock as assets, I would go somewhat conservative there,
Mm-hmm.
and again, make sure you talk to the lender to see a worst case scenario of what your cash to close would be, and and if that's anywhere on the edge, I would liquidate as soon as possible.
Okay. Yeah, that makes sense for that situation. Because there is going to be a gap between the time that the stock is liquidated and the time that you're going to need to bring that money to the closing table, essentially for whatever you're purchasing, correct?
Well, I had a guy not long ago that there's two things. One, there's a little bit of a process, and it kind of takes time to liquidate that stock and have that put into your checking account, which is necessary, right, to show that it's actually been liquidated and now it's in your account to be used.
Mm-hmm.
The individual that I was doing a loan for, the stocks were rebounding. They were going up. He's like, I'd like to wait a little bit longer. There's a fine line there. So I gave him a deadline. I told him, Friday the 15th. Beyond that, you got to do it. He waited about a week afterwards, and it got very close, and it was almost to the point of him delaying his closing. And on top of that, that rebound of stocks dropped dramatically. And it was about, by the time he liquidated, and it was somewhere around $100,000. I think there was maybe a $400 variance. It was close. I can never force a customer to do anything, but I'll give my thoughts and highly advise something. So I would, that was a little close, too close to call. So, I was with him. I was with him, and I was stuck because I was like, I want you to, I know the stocks are going up. I'm enjoying this as well. And I want you to rebound, but first and foremost, I got to make sure that I get your job done and get you close on time. And this is it. We need this liquidated by this date. No ifs, ands, or buts. But stock can be used. Just you want to be a little careful there.
Yeah. I know who you're talking about, so it's okay.
Yeah.
So Michelle has another question, and I'll kind of put in her notes here. She says, what about transfers from a regular account to a savings account within the same bank is kind of what she meant, because she corrected that. So if you're, say you're moving money from your savings account to probably your joint checking or your checking account, is that going to cause a lot of red flags on the lender end of things?
Not really. And again, I see that all the time as well. I mean, I do that to some degree, and I have many different accounts, but In that case, like when I'm going over the application, and I'll go over the conversation of large deposits. Is there anything I need to know about, and whatever, right? And they say, well, yeah, no, I just transferred from checking to savings, whatever. Then I'm probably just showing both of those statements, and that way, when the underwriter picks up the file, they'll see that transfer here and here to there, and they're self-sourcing each other, right? So we can explain those deposits without even bothering the customer on it. It's mainly when Aunt Sue gives you a $10,000. I mean, I don't have an Aunt Sue that'll ever give me $10,000, but maybe you do. And if they did, they give you $10,000 and wrote you a check for it, and you deposit in your account, and we see that statement, we're going to say, oh, well, wait a minute. We see a check from Aunt Sue for $10,000. What's going on? This looks like gift funds, is it? And if so, that's fine. But she has to sign this gift letter. And you might say, well, no, this is for my birthday. And then we'd get an explanation from you, and we'd explain it. We just the whole purpose of that is they're trying to keep bad apples that are trying to invest in the real estate, right? And it's nothing personal. It's just that the guidelines say on conventional financing, anything greater than 25% of the gross monthly income. I'm sorry, 50% of the gross monthly income on conventional and 25% on FHA. Or if there's a pattern of multiple deposits, then the underwriter can ask questions about it. So it's so for what you're talking about, Michelle, not a concern, especially if you're just transferring from account to account. The problem is if you're like me and you have 8 or 9 different accounts, and if you're transferring to all of them, you're showing 8 or 9 different accounts to an underwriter, and maybe on the application you only show me 2. And then we got to ask for a third. Oh, now there's a fourth. Oh, we see a fifth, and before you know it, you're showing 8 different bank accounts. So in a perfect world, a couple months in advance that you're buying this house, you have money, and the money's in one account and sitting there. And sometimes that's not possible, and that's okay. But for me, on the house
just
that
give the lender
we're going to buy,
worst case scenario, just say, here are all of my accounts. This, just kind of be, I think, as open as possible, correct? And that's going to be the best case scenario, or no?
Yes, yeah. Well, so you brought up a good point there. So be open with your lender, talk to them. Don't necessarily. I am not a lender that I want to see all of your documentation. And I thought, I think you stopped yourself, or maybe I heard differently, but I thought you were about to say, send all your documents to the customer or to the lender. That's not true. The way I conduct my business is I pre-underwrite that file. I'm acting as an underwriter. I'm seeing what documents we need and not want, right? I mean, if I want to see a document, I'm going to hold off, and I'm going to make sure the underwriter wants to see that as well, and then justify that it's needed through the guidelines. But documents, once you send in a document, you can't take that document out. And sometimes you send a document, that document causes for 3 or 4 other documents, and then those 3 or 4 other documents may or may not be a deal killer, right? So you don't want to send everything in. You want to send just what's needed, nothing more, nothing less, and that's where you need to rely on the loan officer to tell you what is needed.
That's a good question, because if it's not needed, don't mess with it. If it's needed, then you'll ask for it.
Tax returns is the big thing. I see a lot of customers who just voluntarily give up tax returns, and that is the number one thing I do not want to see unless it's absolutely needed.
Okay.
Yeah.
That's good. That's awesome. Randy has a question. He said, is there anything someone can do to save on closing costs? It's so expensive. Randy, I hear you. It's not cheap.
The typically your lender's fee is not expensive. Ours is $1,300. Not to say that's not a lot of money, but the rule of thumb on title fees, assuming a seller won't pay for it, and very few are paying for your title fees in this kind of market, is 1% of the loan amount. If you're buying a $400,000 house, 1% would be $4,000. I think the title fees on that might be closer to actually $3,200, something like that. Nonetheless, a few $1,000s for closing costs. That's typically what it costs. And
so don't buy a big house. Don't buy a house that's cheaper and it's closing costs.
No, I mean, Randy, is there anything to do to save on closing cost? Not not real. There's a couple answers to that. So the immediate answer is no. I mean, you can't, because a lender, fair guidelines now, right? Which is good because everybody's treated fairly, and that's the way it should be. But a lender, like if you were to come to me, I couldn't just say, I like it. I'm going to waive the origination fee, or I'm going to waive the lender fees. Even if I wanted to, I couldn't do that at all. Like the business would never allow it, and I couldn't because of fair lending guidelines. Same thing with title. I mean, good luck trying to get a title company to waive their fees, and a lot of those fees are paid directly to the county. So,
and they're all pretty fixed. They're all pretty fixed because they can't compete against other title companies when it comes to certain fees, because it's fixed across the board with your title fees.
A title fee, so where you'll see the variance of title fee is something called an escrow fee, and the escrow fee is I believe typically goes to the escrow officer that actually closes your loan. And you might see an average of $200 to $450. So there's a couple $100 difference there. Typically, you'll see from title company to title company. I'll say this: there actually is one way there, Randy. It may not be the ideal way, but there is a way that you could have a lender pay for all of your closing costs, technically. So hear me out. Your information drives your rate, right? Your credit score, your loan amount, your down payment, and your location of property are in your term, 30-year, 20-year, 15-year, right? Those are what drive your rate. For the sake of conversation, let's say your rate is 3.5%, okay? You have the ability to say, well, I want a 2% rate, right? You could have that 2% rate. You could pay for it. You could pay out of your pocket and buy that, buy discount points is what it's called. You could buy that 2%, given the loan amount might be $17,000, right, or whatever, right? But the point is that you have a par rate based on your information that you could go down and buy that rate for, or you can go up in rate. And if you go up in rate, a lender can't just keep that extra money, fair lending guidelines, right? So we have to give you a credit towards those closing costs. So like, let's say that 3.5 is your standard rate, and you say, well, I want to take a 3.6. Well, that might give you $800 towards your closing costs. 3.75 might give you $1,800. Maybe that's a little bit higher, and that gives you $1,800, right? And 4%, maybe that pays for all of your costs, right? Why would you do that? You wouldn't or shouldn't if you're going to be in that house long term, because obviously the higher rate will be more money in the long run. But when there's a lot of relocation deals. If somebody says, hey, I'm relocating to Texas, I'm buying a house, I'm only going to be there for 2 years, I'm having that conversation. Hey, don't take the low rate. Definitely do not buy the rate down. Take the higher rate and make it a free transaction. You still got to pay your down payment, but have that rate pay for the cost, because you're going to be in this house less time than it will take to recoup those fees. Does that make sense? What I'm trying to say?
Makes sense.
Explaining that well. So there's that. That's essentially that. And if somebody's trying to buy a house, and the down payment has to come from you, right? But if you have the down payment but don't have enough to cover closing costs, that's another way that we could save the deal, by going up in rate to pay those to make sure you get in that house. Not the ideal way, but an option nonetheless.
I wonder would a flipper be able to use something like that to decrease their closing costs, because they're only going to hold the property for a short period of time, pay the higher interest rate, get some of their closing costs paid for, and then turn over the property and sell it, because they're not going to be holding that rate for very long. Is that something you've run across?
That's another scenario where I see that more commonly. Yes, absolutely. So if you're going to have the house short period of time, that's the best way to go about it, in my opinion. If the only other way that you would use that option if you had to.
Yeah.
On the flip side, I wouldn't consider buying discount points, buying that rate down, unless you plan on being in that house for a minimum of 5 to 7 years, minimum. A lot of times it takes wide spectrum here, but anywhere from 3 to 8 years is typically what it takes to even break even from buying points. Yeah. There's a lot of variance there because it depends on the rate, term, all of that. But yeah, buying points. I'm a big fan of on investment properties, not always primaries because a lot can happen. And unless you're for sure this is the forever home.
Right. Yeah. No, those are all that's great. I've never thought about it that way. I've always heard about about the down payment assistance program where you can get money towards your closing costs at a higher interest rate, and it's kind of the same boat,
So
except for it's, I guess the down payment assistance program is an actual program by the government versus what you're talking about is the actual lending institution giving you money towards your closing costs for a higher interest rate.
it's basically saying, yes, like you qualify for a lower rate, but you're choosing to take a higher rate. And as such, we can't just keep the difference. Without going too deep into this, there's with each rate, there's a pricing, there's a number, right, that tells us how much each rate up or down either costs you or gives us a credit. And so it's one of those things that it's not a fixed amount. It all depends on how attractive that particular rate is. So if somebody's looking to buy points or buy the rate down, I'm looking through there and I'm saying, okay, and I can look at the price and I can say, okay, the 2.3 is attractive, 2.5 is horrible, 2.6 is horrible, 2.7 is okay, but 2.3 looks to be the best. And then right off the bat, I'll know when I calculate that, and I'll say, okay, looks like that's a 3.5 year recoup time. So it'll take you 3.5 years to break even, and then it's $724 savings per year thereafter, right, or whatever. But so probably getting off track here, but
No, I feel like that's a great answer to a difficult question. So, title costs are fixed. If you want to recoup, if you want the lender to help you pay for some of your closing costs, expected at a higher interest rate. And I mean, shopping your lender too helps as well, because some lenders will be based off of a percentage and others will have a flat fee. Especially if you're buying a large property that's $1 million, you don't want to get that lender that's based off of a percentage, right? You want probably more of a flat fee for that type of property, just in general. But
anybody that's watching this that's in mortgage that charges a percent of your loan as their origination is going to hate me for saying this, but odds are that is the lender that I do not want to use. More commonly, in all fairness, there's usually not a big variance between lenders on their closing fees. So the origination, you'll typically see anywhere from $1,000 to $1,500. I'm not saying a couple $100 isn't a lot of money, but in the scheme of things, of your $300,000-$400,000 house, a couple $100 isn't a big part of it.
right.
And for that matter, rates. Most people,
Yeah,
all lenders are watching each other on rates.
Mm.
So I'll say this, and this is important for anybody who's watching. If you see anybody that offers a rate that is much, much lower than everything else that you're seeing out there, red flag. There's probably discount points in there. We are all watching one another, and we're all competitive. Will there'll be a slight difference in rate? Yes. But if there's a dramatic difference, usually, not always, but 9 times out of 10, if somebody has a dramatically lower rate, it's probably some smaller brokerage that is hiding discount points in there. And then you'll get to closing, you'll notice that there's an extra $10,000 in closing cost, right? Or you'll see it on the loan estimates, whatever. So I've seen that a lot. I've seen people come in and say, well, I'm getting this rate. And I'm saying, okay, let me see a loan estimate. And look on there and I'll see, oh yeah, you're paying $12,436 in discount points. I can do that as well, only at $9,732. But
yeah.
Anyways, not to go down that road, but wanted to bring that up.
No, that's great. A great point to make. That everyone, for the most part, they're watching their rates. I think customer service. It really kind of if I'm choosing a lender, it's going to come down to the level of service that they're providing. It's kind of the same with title companies because I hate to say it, you really do get what you pay for. If it's a lender that's not very responsive and they're giving you this great deal, you're going to end up paying for that great deal down the road. Just like if you were to go to the dollar store and buy something and then turn around and go to Target and buy something, the quality of the item is going to be different. So it's the same as, I feel like the same is true for real estate agents, for lenders, for title persons. To me, it really comes down to how knowledgeable the person is and their customer service, how they treat other people, what type of integrity they have.
Knowledge is very important in this. Someone that's knowledgeable. They're, you know, I've always said this, that you got to start somewhere, right? But if you have not been doing mortgage for at least a couple of years, you just do not know what you're doing. There's so much to it. So I think that it's very important to have a knowledgeable loan officer. I think, as well as customer service, someone that picks up the phone, someone that works late. But yeah, having someone that knows these guidelines is important. Absolutely, 100%.
Yeah.
Yep.
All right. Well, we are, wow, an hour and 20 minutes. Sorry. I was watching the time, but then we just kind of got sucked into it.
Time flies when you're having fun.
I know. Well, thank you so much for coming on. Do you have a Twitter handle or Instagram that they can follow you on, Josh?
We're working on that. To be continued. I'll get that.
Okay, to be continued. So what I'm going to do for you guys is in the description below, if you need Josh's information, just let me know. I'll have my contact information and I can connect you with Josh. And then we'll move forward from there. But thank you so much.
Pleasure. Yeah, it was fun.
For joining us a little bit here today. And we look forward to having you back on, maybe with my friend who's an appraiser, and have a really good conversation there. So.
I look forward to that. Yeah, anytime. My pleasure. Thanks for having me.
See you later.